And as technical analysts, what we're doing is recognizing that price has information, just like earnings do. By analyzing historical price action, we can make some informed assumptions about what may come next. And the whole growth in behavioral finance, I think the whole growth in momentum investing has helped to clarify and I think put academic rigor behind things that technical analysts for decades, if not centuries, have understood, which is markets tend to trend, right? Markets move and those trends tend to persist.
Welcome to the Advisors Fuel podcast, where high-performing financial planners and wealth advisors discover proven processes and actionable strategies to elevate their client experience, grow their businesses faster, and achieve unprecedented success. Here's your host, Adam Koos, founder at Adrenaline Advisor Consulting at adrenalineadvisor.com.
All right, everybody, I've got my good friend Dave Keller here, Sierra Alpha Research. We're going to get Dave talking about technical analysis, portfolio management, because I think we're both cut from a similar cloth and that we're both relatively modest people, but I don't think he gives himself enough credit for his experience and all the stuff he knows. So this should be a lot of fun, but thanks for being here.
No, it's a pleasure, Adam. Thanks again for coming on my show. It was a lot of fun. So yeah, looking forward to it.
Yeah, no, it was a blast. Yeah, you were kind enough to have me on. It's Market Misbehavior, by the way, to everybody
That's
who
right.
doesn't know. So if you're a podcast listener, feel free to go over, find Market Misbehavior everywhere. It's on all the socials. But check that out. That episode was a lot of fun. This is going to be different, but it was a fun conversation. So anybody who is listening, watching, be free to check out that on Dave's YouTube channel, but it's worth a watch. But I'm going to steal a page from your, I wanted to call it a rule book, but a checklist, right? Pre-flight checklist.
Yeah.
On brand here, because Dave's a pilot as well. I didn't mention that in the intro, but hence Sierra Alpha Research and the logo and everything. But I wanted to start this episode with the way you started yours. We both grew up similar surroundings. We both went to Ohio State University. We both had aspirations that looked very different from where we actually ended up in career-wise. So can you start by maybe just sharing your journey? How'd you get into this business? Where did it start? What that process brought you over in the world of portfolio management and investment analysis?
Yeah, for sure. So I really had, I guess, one of the many non-traditional backgrounds I've heard of where I studied liberal arts as an undergrad and was big into music. I went to Ohio State to be in the marching band, be in the men's chorus there, and ended up with degrees in music and psychology after, I'll admit it, about 5.5 years as an undergrad because of how many times I changed my major. But the number of times I switched my major, I think reflects how much I'm drawn to a lot of different things, which is, I think what I appreciate so much about investing is it basically forces you to be a lifelong student of just learning about new technologies, new themes, new dynamics, which I love. So as a music and psychology graduate, I was sick of the very cyclical income stream of a working musician. So I would have a really amazing week and then I would have struggle to find how to pay rent the next month kind of thing. So I was looking for consistency, right? I had a very volatile income stream. I was looking for slow and steady gains and found Bloomberg, which was a firm based in New York City that hired a bunch of liberal arts majors. And they found that, I think, because I remember hiring for them, they found that liberal arts majors asked good questions. They tended to be good presenters. They could sell pretty well because they could connect with people. And they just had to, and this is, I feel like the skill set I generally had. I knew nothing about the markets. And thankfully, they had really smart people that taught you about the Fed and how to calculate bond yields and economic indicators and fundamental data and technical analysis. And when I learned about technical analysis and found there was a set of tools that would basically help you understand the psychology of other investors, it was like my undergraduate degrees somehow were tailored for that. So it was somehow a very good transition. And then once I learned about technical analysis, I almost couldn't get enough of it. I loved reading about it. I loved meeting people that traded using charts and went from there. And from there, it was meeting, I feel like, the right people and finding mentors that helped encourage me, and then was able to drive that to further success as a technical analyst over time.
Like it's not quite the internet, but there is no shortage of analysis and obsession that you can
Yeah.
implement into this craft. That's for sure. I remember Tommy Dorsey telling me that it took him 10,000 hours to master it. I don't know if
Yeah.
it was 10,000, might have been 1,000 hours is I think he used to tell people, like, you need to spend at least 1,000 hours studying something before you can really say you mastered it.
Yeah.
But
Yeah.
anyway. So, well, What was the idea behind launching Market Misbehavior and Sierra Alpha Research for that matter? How do you work with advisors, financial professionals, and retail clients?
So my career's had a couple different chapters, as many do. So my first kind of 8.5 years were at Bloomberg in New York, where I really became a technical analyst. That's when I got my CMT designation, so formalized my education about charting and technical analysis, and wrote a book. Actually, edited a book that had chapters written by different technical analysts, Connie Brown and Tom DeMark and a bunch of others. Wrote chapters. Coming out of that, I was really excited to elevate my own career, and then found a role at Fidelity that was interested in having me there. So I became a director of research at Fidelity for about 9 years up in Boston. So I ran the technical research department, and we worked with all the equity portfolio managers, and to a lesser degree, like asset allocation and fixed income managers. But it was primarily with the equity investors. So it was, I mean, some of the really successful fund managers. Peter Lynch, obviously, in the twilight hours, days of his Fidelity career, he was still a great mentor to all of the interns and everything. So I was able to work with him to a degree. But it was Will Danoff and Joel Tillinghast and many of the other fund managers there. And what was interesting to me is during that period, I learned that analyzing the markets using technical analysis was super interesting to me. And I enjoyed it. And I loved the challenge of it. I also learned that managing money was not something I enjoyed doing. I hated it. And I had opportunities to manage other people's money. And I found that is not, there's a skill set I don't have. That is something I'm not excited about.
Why?
But I loved educating. For me, I think it was stress. I think it was more stress. Internalized a lot of that stress, the challenge of having portfolios perform well. And I found that what I really enjoyed was mentoring portfolio managers that didn't really understand the technical and behavioral sides of it. So what I started specializing in, probably whether or not Fidelity was happy about that, I specialized in teaching people outside the firm, going on speaking tours and educating the public about it and going to our advisor network. So I went to a random office in like Minneapolis, and I'd email the head of the Fidelity office there and just say, "Hey, I'm going to be in town. Can I talk to you, the advisors there, about the chart room?" And they were thrilled, and I was thrilled, and I enjoyed it. And so I found that was something I really appreciated. And then working with the fund managers. So I would, anytime someone had a new mutual fund assignment, especially after being a fundamental analyst, there would be this point, and you could almost set a clock. They'd sheepishly come in my office and be like, "Hey, I'm having some challenges, and the guy next to me said I should come talk to the chart team." I was like, "Perfect, come on in, sit down." And I would be like their therapist and just think about, all right, how are you selecting stocks? How are you managing risk? How are you? And we would just identify some very clear areas where charts could help them either better identify opportunities or better recognize when bets they had made were no longer helping the portfolio. But it was less about predicting the future, it was more about just analyzing the evidence of the markets. And so when I left Fidelity in 2016, I spent some time just thinking about what I wanted to do when I grew up, kind of work, and then realized that writing a blog, I really enjoyed. I'd never written a blog before. I loved it. I actually moderated a panel because the moderator didn't show up to this event. And so they're like, "Hey, Dave, could you moderate?" I was like, "I bet I could." And so I jotted some notes out. And as I'm doing it, I'm like, I'm supposed to do this. Like, so I'm supposed to do this right here. And so I found I could make a business called Sierra Alpha Research that was built on mentoring advisors, which is what I did going around to the networks. It was helping people use technical analysis to manage risk, which is what I did with the fund managers. And then launching a podcast was basically, yeah, I think I'm a decent moderator. I think I can interview pretty well. So it was basically combining all the things I enjoyed doing in my previous roles and jettisoning all the things I hated doing, which was budgeting and strategy and all this other stuff. And I'm super thankful that I can get paid doing it. So it's been a true joy, I think.
I'm not sure if you're familiar with Gino Wickman, traction, EOS, that stuff.
No.
One of the things we teach in the adrenaline program for advisors,
Yeah.
but he takes a quadrant graph. It's a quadrant graph, and in the upper left, you put all the things that you love that you're awesome at. In
Yeah.
the upper right, you put all the things that you like and you're good at. Bottom left, all the things that you don't like but you're okay at, and the bottom right is all the things you hate and you suck at it. And everything below the midline, you get rid of it, you delegate it. So I think you did a good job of that. And to speak before I want to talk more about market misbehavior, Sierra Alpha Research, but
Yeah.
you made me think of something. You mentioned the chart room in passing, and
Yeah.
I don't think most people who are going to be watching or listening to this know what that is. Can you give
Mm.
us a quick a quick rundown of what the chart room is at Fidelity?
Yeah, it was no, and it should be celebrated. It was a really and still is a fantastic physical space dedicated to market history, dedicated to investor psychology and sentiment, and really trend following. I mean, the chart room started in the 1950s when the first Fidelity fund manager, who was Edward Johnson II, who created Fidelity and started what it eventually became, he basically really found it valuable to analyze the markets visually. And so he hired a team to update charts by hand. Eventually became called it the market research team, and eventually became the team that I ran in the 2000s. But I spent a lot of years meeting with people who had run that group in the past. So Bill Doan ran the chart room in the 1970s, and I got to talk with him a lot about just what that was like, what the 1974 low was like, what the fund managers would do. And back in the day, they would literally do a weekly meeting in the chart room and they'd have all these big paper charts around them. It was like, all right, it was like war room style. All right, what's happening? Bill would lay out, here's what we're seeing. We're seeing these opportunities. This looks good. This looks bad. And by the time I was at Fidelity, the firm had obviously grown quite a bit. We had 75 some portfolio managers just in the equity division alone. And we were managing at the time just under $1 trillion in assets for equities. And now it's well above that with how the market has performed since then. But we would still conduct regular tours of the chart room and bring portfolio managers through. We would bring a bunch of people from the Fidelity Advisor Network, clients, and we bring through and just talk about this is what nominal returns, but this is what the market did in the 1970s. This is what the real returns were like. They were a lot worse. And like lessons like that are so relevant to today. Today is not the 1970s, but there are a lot of similarities in terms of the devaluation of the dollar and the fact that the market's making new all-time highs, but it doesn't feel very good. And it was like the chart room always provided these great history lessons of this is when it happened before, and this is what it felt like going into it. This is what it was like to manage money through it. This is what 1983 was like, and this is how you could tell that things were finally getting better. And so for me, that's something I've tried to emulate. Anyone looking at the video, I have charts, paper charts in my office today. And it's
Yeah.
really it's like my security blanket from being in the chart room and just realizing having those big historical lessons made so much sense. And it helps you understand and appreciate what's happening today because the markets have cycles, the markets have patterns because they're based on human nature. And I think that's relevant today as much as ever. And that's what I learned from time in the chart room for sure.
And there's the great Mark Twain quote, "The history doesn't repeat itself, but it sure does rhyme," right?
Rhymes. Yeah, that's right.
Sure does rhyme. So give me before we I wanna go back to market misbehavior and Sierra
Yep.
Alpha in a second here, but before we do that, give me your favorite story at Fidelity. There's gotta be one that when you look back, when you're hanging out with your wife and other couples and somebody's like, "Hey, tell me about some time that was a cool story about Fidelity." Do you have a favorite story?
Oh, man. So my Fidelity years, yes, a number. What's a good one? To be honest with you, my favorite story, my favorite times from Fidelity were the chairman. So Edward Johnson II started Fidelity. By the time I was there, Ned Johnson or Edward Johnson III was the chairman. Now it's Abby Johnson, his daughter, who's now the chairman. But and Ned Johnson passed away years ago. But he, at the time I was there, certainly when I started, it was incredibly stressful. And when I interviewed at Fidelity, I was in New York at the time. I went up to Boston a couple times, one to meet with a couple people, the second time to meet with some of the portfolio managers and some of the other analysts. And I thought we were pretty much done. And then I got this call and it said, "Hey, the chairman wants to meet with you tomorrow." I was like, "Okay." So I got on a plane and flew up to Boston just to meet with the chairman. And we met in his office, which is at their old office at 82 Devonshire, right in the financial district. And for about 2 hours straight, he grilled me on market history, on data visualization, on leadership themes, on sector rotation, on what works and what doesn't, on why you use certain technical indicators at different points in the cycle. And it was at the beginning, I'm like, he is really trying to, I guess, challenge me on everything. But by the end, it was like chatting with an old friend about the markets. And it was like talking with an encyclopedia of market history in a very enjoyable way. So by the end, like we were laughing, having a great time. And I guess it went well because I got the job. I got the call the next day when I got back to New York. It's like, yeah, you're starting in a month. But after that, about every 6 weeks, we had a phone in the chart room, and it was almost like the red line, right, with, like, the unknown thing, and it was literally a phone that was just to the chairman's office, and we would get a call with about 6 minutes warning, and it was, "The chairman's heading over because we were in a different building by South Station. It's like he's coming over," and I would grab whatever of my analysts were nearby, be like, "All right, we're going with the chairman." And we would meet with him for anywhere from 45 minutes to 4 hours, however long he wanted to go through there. It's just he just wanted to talk about the markets. He was done screwing around with managing this huge multi-trillion dollar fund. He's like, I just want to look at charts and talk about the markets. And those were, looking back, some of my most stressful days, but also I'm so thankful for those days as well because it was a really good, cool opportunity to work with a legendary investor. And yeah, that was one of my favorites, I think.
You
The
live
the
to tell the
hotline, the
story.
chairman's hotline, we called it.
The chairman's You live to tell the story. So
Yeah,
the timing of us doing this podcast is so perfect because I'm gonna leave everybody nameless here, but I was asked to be on a portfolio management panel that meets monthly. And I'm so busy all the time I can never make anything, but I was able to make the first one just yesterday, and I think it's their third one, maybe their fourth, I don't know. So I come in there and there's 8 of us. And you and I are very passionate about what we believe in when it comes to technical analysis and the
sure.
markets and behavioral psychology and all these things. I know we agree, but
Yeah.
let's just say that other people on the call didn't necessarily agree with me. Now, I didn't
Nice.
say a word. I didn't say anything, but you know what I'm talking about. When I get on this call and in our business, in the financial advisory world, we're all taught to go out, find a story, and I hate that phrase so much, but I passionately hate the phrase, "Find a story," and then tell the story. It's like sales, and go on and sell this story, whether it's mutual funds or ETFs, doesn't make a difference, and then you're taught on the brokerage side of the fence to beat up a portfolio like a used car. I think we talked about this on your podcast,
Yep.
and then use research like that had find the best five-star mutual funds or ETFs over the last 5 years as if they're gonna continue to be 5 stars for the next 5 years,
Yeah.
and then use fancy words and then convince them to buy your portfolio and sell theirs and then go find more clients. And I think it's so infuriating to me. That's what the distribution funnel for investments are people who are taught this way, me included. When I started my career, that's how I was taught. And so I'm on this call with portfolio managers and it was worse than I thought it was going to be. Somebody starts talking about Harry Markowitz and then
Right.
somebody else chimes in to say that, oh, I used to know him. I'm like, oh, great.
Oh, perfect.
And it's like, this call goes on for an hour.
Yeah.
And at the end of this call, finally, they wanna do a poll. They said,
Mm,
"Everybody, we're gonna ask everybody, do you focus on active? Do you focus on passive, like active money managers, SMAs, passive like ETFs, or Bacter?" And
okay.
it gets to me, and I say passive, but I manage all my own models using technical analysis, relative strength. And somebody goes, "Ah, that's the CMT after your name." And then I'm just like the leper in the room. You know what I mean? I can't remember who said this at a CMT conference years ago, but it was maybe it was 2022. Somebody said that technical analysts are pretty much the lepers in the room until the market starts to go down. Then everybody wants us on CNBC. But that's my very, very long-winded, you know that I'm not the most concise person in the world. That's my very long-winded way of transitioning into Sierra Alpha, market
Yeah.
misbehavior, behavioral psychology for investors and financial advisors
Yes.
who don't use charts or
Yeah.
technical analysis, or they've been taught that it's voodoo. How do you explain the value of technical analysis in plain terms and I guess dispel those myths?
It's so interesting, and I feel like you're right. I feel like a lot of investors, a lot of advisors have been a disservice has been done that they have learned that it's a really bad idea to pay attention to what the markets are actually doing. It's you're basically taught to either sell a narrative or as an analyst come up with a story of why some company is going to succeed and then have that be your investment thesis. And then chart and performance is like an outcome, right? It's like you do all the work and then hopefully you're validated by the fact that the market does what you think. But I would always, anytime I've tried to describe the benefits of technical analysts to a group of investors, advisors, whoever, I say, all right, have any of you found a stock or an ETF, a company? It looks good, good management team, great story, good catalyst for growth, good expectations for earnings. You buy the stock and it goes down. And 100% of the hands go up because that happens all the time. And it's like, what did we miss? We didn't pay attention to the fact that price matters. Price has value. Our mutual friend Craig Johnson, right, who's the technical analyst at Piper Sandler for years, he would always portray it, which I think is really good, thinking of valuations, thinking of the PE ratio, right? You're looking at price, you're looking at earnings. And if you're analyzing the markets fundamentally, you're basically trying to define the E, right? You're analyzing earnings and you're projecting, you really are trying to predict the future of how this company is going to be able to grow and at what trajectory over a certain forward-looking time period. And then the price is then what you compare it to. And as technical analysts, what we're doing is recognizing that price has information, just like earnings do. By analyzing historical price action, we can make some informed assumptions about what may come next. And the whole growth in behavioral finance, I think the whole growth in momentum investing has helped to clarify and I think put academic rigor behind things that technical analysts for decades, if not centuries, have understood, which is markets tend to trend, right? Markets move and those trends tend to persist. And if you Google momentum factor, you'll see a bunch of well documented and peer reviewed studies that demonstrate that over certain periods of time, which is where I try to operate and focus my attention, trends tend to persist. So relative strength has value, and finding what's working is going to help you identify or anticipate what might work going forward. And what behavioral finance does is it just sort of clarifies and validates the fact that investors are inherently irrational because human beings are inherently irrational. So if you had a finance professor that taught you that the markets are efficient, I'm sorry, but it's just not true. And when I taught second year's master's students at Brandeis University a number of years ago when I was in Boston, I felt like my role in the second half of their second year was to unwind some of these things that they learned in their first year and a half, which was markets are efficient. It was like, no, they're not. And what I would often do is play a audio of the flash crash or some day in the pit where you could hear sentiment, right? You could hear panic boiling up. And it's like, does that sound rational to you? Does that sound like a bunch of rational actors getting together and exchanging things at fair value? Like, no, it was just panic. It was fear, and that was defining decision making on that day. So to be honest with you, I think the benefits of technical analysis are respecting the fact that markets tend to trend, helping you just define what's working and what isn't. And I feel like for a lot of investors, they spend too much of their time thinking of things like technical analysis as a crystal ball, trying to predict the future, and underappreciating the value of technical analysis as just like a microscope and I guess a microscope and also like a, what do you call it, like a satellite, just looking at the overall performance and just recognizing what's happening and what's working and what's not. It's not about predicting the future. It's just about acknowledging what's happening. And a lot of times when we make bad decisions, it's holding on to something way too long and not acknowledging the fact that the picture has changed. So let's keep a good routine focusing on what the picture is at any given point.
You mentioned
I'm
this. You,
preaching to you, Adam, who I think
no, no,
appreciates everything I just said
I
probably
do.
very
I'm a great audience.
well.
It's like a comedian doing a performance in front of his family. You're gonna
It's
laugh. No, in all seriousness, though, it's I think on your podcast I mentioned Tommy Dorsey's quote. At least it's probably not Tommy's, but he always told me, "There's nothing wrong with being wrong, just don't stay wrong." That's the first one. And I think technical analysis at our office, we always tell people that we're not trend predictors, we're trend followers. There's a difference.
Yes.
We were talking about a couple quotes. These are great. I'm sure you've heard them both, but the one I dug these up when I first started using technical analysis in '08. I didn't realize how easy it was. Simple, not easy. They're different words to educate clients, the investors about it, about technical analysis and the value. It's logical. It makes sense. I found it
Yes.
very difficult to get peer buy-in.
Yeah.
Everybody thought I was a witch. I needed to be burned at the stake. But here's a quote: Eugene Fama in 1993 in his Nobel Prize winning paper on modern portfolio theory, confirming Harry Markowitz's 1952 paper,
Yeah.
said in the paper, momentum investing is the main embarrassment of the buy and hold model.
Yeah.
I don't know what else there is. And then
Tells you something.
here's my favorite quote of all time. And you really got to dig to find this one. I'm going to let you guess who said it, and maybe you already know. The disservice done students and gullible investment professionals who have swallowed modern portfolio theory has been extraordinary service to us. In any sort of contest, whether it's financial, mental, or physical, it's an enormous advantage to have opponents who have been taught that it's useless to even try. It's a great quote, isn't it?
I've never heard that quote. That's an awesome one.
Your mind's about to blow up. You ready?
Yeah.
Warren Buffett.
Wow.
Yeah. I'll send you that one. I use that all the time.
And Buffett is Graham disciple, and Benjamin Graham was called like arguably the first market behaviorist. Right? A lot of his it's all about valuation stuff, but there's a lot of language in his work that is very behavioral and very about investor psychology. I'm not surprised, but surprised at the same time.
I
That
think
Buffett
everybody
quote.
thinks of Warren Buffett as, "I buy companies, I hold them forever." And the
Yeah.
truth is, the real truth is, he buys the whole damn company, let's be honest. He's not buying shares usually. He's like George Clooney on that one movie, like, goes in and starts chopping shop, but anyway, I digress.
No, and while we're throwing quotes around, the John Templeton quote: "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria."
I love that
I
one.
think that quote describes so much of where I think technical analysis can be valuable. Is just recognizing what phase we're in, recognizing if we're in a cycle of accumulation or distribution, recognizing that you buy when there's blood in the streets, ideally, right?
Mhm.
Things get so bad you can't imagine wanting to buy. That's what it felt like in April of 2025. Looking back, perfect time to be adding to long positions. And then when you feel those signs of euphoria, when you feel excessive optimism, that's when you need to start fading things. And human investors love to fight those tendencies, but it's true. And market history is filled with examples of that cycle playing out.
I love that you said, "Buy when there's blood in the streets."
Yeah.
I don't wanna waste too much time on this, but I have to tell this. I used to do these events like 15 times a year for 10 years from '07 to 2017, and that's where I mentioned this Eugene Fama quote, the Warren Buffett quote. I'm teaching
Yeah.
investors about technical analysis and trend following and things like that. There's these charts that I show where it's like diversification in a bull market looks beautiful, and then in a bear market, all correlation coefficients come to 1. Who
Yep.
cares, right? But here's the story. It's about, Baron Rothschild, who was the person
Mhm.
who said that originally. It's June of 1815, and Napoleon, with 100,000 troops, is marching toward Waterloo, where he's gonna hit Wellington of Britain. Everyone in London's worried about Wellington's gonna lose the war, this herd mentality, right? And
Yeah.
they're all watching one individual who will soon become the wealthiest man that's ever lived, Baron Rothschild, because they thought he might have more information than them because everybody followed Baron Rothschild. He was a smart guy. And we didn't have Twitter back then, so he used homing pigeons to find out who had won the war, and hours later, he finds out that who wins the war. He goes and he sells everything, and everybody sells with him, and
Yeah.
then he buys everything in sight, and he makes so much money, and he says, "You buy when there's blood in the streets, even if it's your own."
Yeah. We don't repeat the end of that quote as much as the
I
main
know.
part, but yeah.
But we did have a segue, I think 10 minutes ago, and you talked about listen, we're having too much fun. I think
Sorry
so, at
about
least I
that.
hope you're having
Sorry.
fun. I'm having fun. You work with a lot of advisors. You mentioned it
Yes.
earlier. You help them build strategies, obviously. I don't wanna lose sight of the fact that I think that what you do for investors with Market Misbehavior and the podcasts and blog are
Yeah.
huge. I would encourage every one of my clients, investors who are watching this, to go sign up for your YouTube page, get on your blog, and read this stuff because you are so good. I pride myself on being really good at making complex things easy to understand. But when it comes to technical analysis and markets, you are so good at making things simple and making it relatable to just the average person. So I think
Yeah,
that
thanks.
everybody should be signed up for your blog and reading it. But anyway, you work with a lot of advisors, investors. You talked about behavioral finance, and you talked
Yeah.
about, let's just talk about biases. What do you see
Yeah.
most shows up? Because I think maybe one of the roadblocks when it comes to technical analysis and retraining all the brain trash that's been fed financial advisors all these years is
Yeah.
those biases that show up so much in space, when whether it's clients or advisors or investors or advisors.
I was gonna say, and I think for advisors, you have the double challenge of you have clients who are experiencing all sorts of behavioral biases. So I'm sure client conversations you have over time are like a petri dish of behavioral biases of all people want to buy too early, buy too late, sell too early, sell too late, just do all of those things because they're reacting based on their emotion. But also as an advisor, certainly if you're actively managing the portfolios, then you have your own behavioral biases to work through and just make sure that you are using best practices and minimizing their impact. What I always tell people, and particularly with advisors, I think what I would encourage people to do is you want to get away from emotion as being part of your investment process. And there's a natural tendency to have emotion be part of that. And that is reflected in a series of behavioral biases that are pretty well documented. Confirmation bias, which is You basically make your decision first, and then you gather evidence to make yourself feel better about that decision you've already made. That is something we do with everything, buying a car, so many things that's part of it, but especially with our investments, right? You emotionally make the decision and then start gathering evidence. The endowment effect, which is basically you hold on to things way too long because of an emotional attachment to a position, to a portfolio, to a narrative. And so even when the picture changes, your brain sort of minimizes the reality that the picture has changed, and you basically have a perfect portfolio for the previous cycle and not for the current cycle. So the way that I found for advisors to avoid things like confirmation bias, which is an emotion driven process, with endowment effect, which is basically ignoring the fact that the picture has changed, is to have a consistent routine, a consistent process of evaluating market conditions. That's what you and I worked on together, Adam, back in the day, was basically looking at how you're spending your time as an advisor and just thinking about what are you doing to gather evidence? How are you tracking how the picture has changed? And so with a lot of my content, it's looking for what I call changes of character, right? The market has a certain look and feel, and then it's different. A lot of that is a lagging indicator. A lot of that is trend following. So we're not, as you mentioned, we're not trying to predict the future. We're just trying to recognize when the trends changed. And so there have been times, 2024, the market was remarkably strong. The equities were in this nice consistent uptrend, and then things changed. And there were signals going into the February 2025 peak that conditions were starting to evolve. Things like divergences in breadth, in momentum, in sentiment, where you could start to see signs that we might be nearing a top. And then there were plenty of signals saying that thing that just happened was definitely a top. And if you missed it, like now's the time. And I feel like just we ignore all of those things. So for me, your time as an investor is best spent by combining leading indicators, anticipating what could help me get ahead of what might happen next. Right now, I think it's seasonality, thinking about what often happens in August and September, but also having a good, healthy dose of lagging indicators, which are just confirming that whatever that previous cycle was is now starting to change. And so when I work with advisors, it's just optimizing and upgrading those tools and techniques you use to anticipate shifts in the market and then recognize shifts in the market, all based on evidence, not based on emotion.
I think I always say that what I think investors want, and when I say investors, I'll say our clients,
Yeah.
is they want 2 things. They want A, to to know that they're okay when things go sideways, like
Yeah.
during the tariff crash.
Yep.
And the second thing they wanna know is that you've got their back and you're doing something about it. You're paying attention and you're doing something. And that's where I feel like technical analysis is such a huge that most financial advisors just never pick up because they've been told all this brain trash. Because during the tariff crash, I don't know about you, I know you said you're not interested in managing money. Somebody who's done this for 24 years,
Yeah.
I can't imagine sitting here at the end of March and having a client call me up and say, "Well, our plan is just stick with it." So what do you do? There's all these tariffs. We got a
Yeah.
most
Hold on.
controversial election in history. People are freaking out. What are
Yeah.
we gonna do, Adam?
Yeah.
Stay the course.
Yeah. Oh.
What are you doing this weekend? I can't do it. I couldn't do it, which is why obviously we agree and why I do things the way I do it.
Yeah. Yeah.
All right, that's awesome. I think that it's funny. I don't know if on your podcast if we talked about our parents, but I hope my dad doesn't watch this now. But when he retired, he started watching so much political news, and I just think it's bad. I just think it's
Yeah.
bad for everybody,
Yeah.
investors, advisors, even worse, to be focused at all on political news.
Yeah.
I just think it's brain trash. I think you got to focus on is the trend up, down, or neutral, and then we talked about this last time, but buy the playoff teams and avoid the rest, right?
That's exactly right. A therapist years ago used to tell us that was shoulding all over yourself.
Nice.
Don't talk about what should happen. And that's what I think what happens when you watch too much news, too much financial media, too much traditional news media. It's like you get caught up in what should happen, right? This is going on. This is something that was announced. And then everyone tries to basically have an educated guess about how that might impact things. What you have to remember about the financial markets, it's never as straightforward as we want it to be. We want it to be super simple. This thing happened. That means rates do this. That means the Fed does this. That means the dollar does this. That means stocks do this. The markets are a complex mechanism with a lot of different things impacting asset values at any given time. And there are plenty of shifts with macroeconomic data, with geopolitical events, with just fundamental data and how companies are trying to grow earnings, just the simple movement and rhythm of the markets. All of those things combine to cause the flickering ticks to fluctuate. So anytime you catch yourself or listen to people too much about this stock, this group, this theme should do blah, blah, blah because of blah, blah, blah. That is a guess. It might be a very informed and educated guess, but it's still a guess. What Ralph Acampora, one of my mentors, whose work I know you follow, he'd always say, "This is price is fact." He'd hold up a chart and go, "This is fact," like this right here. And so it's like you're not debating what the price is doing, like that's what's happening. And so I would encourage certainly advisors and investors as well to think less about what should the market do and more about just opening your eyes to what the market is doing. And I think there's plenty of opportunity to perform quite well over a long period of time by just focusing on the message the markets provide back to us in the form of price action and in the indicators that we follow.
I know that one of the things that you and I talk a lot about behind the scenes is not only focusing on what less on what markets should do, but when markets should do something and then do something else. That's something you should be paying attention to, not to complicate things.
That's right.
But it's like, we had a couple clients that called us in February, March, and they're like, we went out cash, all cash. And there's a couple that are still at all cash right now. And the reason I want to tell this quick story about the fact that we've been back in the market 100% to target. Our tactical model has one tiny little 2% cash position. That's it.
Yeah.
Um, but we've been back to target for a while now. And I know to people who don't believe in technical analysis or those that think it's voodoo are thinking, wait a minute, I'm telling my clients the same thing that we're still in the market's all-time highs. That's right. But the beauty of technical analysis, I think, is that there's nothing wrong with getting back in. There's nothing wrong with a whipsaw getting you out and getting you back into the market. I think that back to that whole "there's nothing wrong with being wrong, just don't stay wrong" quote.
Yeah.
I just think that we're all trying to do the same thing. The only difference I think between fundamentalists and technicians is fundamentalists are looking for what to buy. I think we're looking for when to buy and when to sell what to buy, if that
Yes,
makes sense.
100%. We and that idea, it's so funny, even though if you study market history, you know how hard it is to invest. You know you're gonna be wrong plenty of times, right? How many times have perfect, and it has nothing to do with how good your process is. Sometimes the market's just not gonna do what you expect. And I know from time at Fidelity, that was a painful early lesson for a lot of analysts, a lot of portfolio managers to deal with, was the fact that they might have gotten straight A's at some elite universities. So you're used to being really successful. All of a sudden, you're getting into an industry where you're going to be wrong a lot. And you shouldn't be afraid of being wrong. You're actually going to be wrong plenty. And that is exactly what the head of the equity division you say. It's okay to be wrong. It's not okay to stay wrong. Peter Lynch would talk about, look, like he was wrong plenty of times. Like I wasn't right all the time. Just when I was right, I stayed right. And when I was wrong, I didn't stay wrong too long. And so it's more of a money management game. It's more of a money management process of just, as Peter Lynch would say, right? Watering your flowers and pulling your weeds, right? Things that are working, you nurture those and help your garden grow. What people tend to want to do is pull their flowers and water their weeds, right? Sell their winners and then double down on their losers. And that is how your garden dies a very probably quick and painful death. So I think that recognizing that you're going to be wrong sometimes, just not staying wrong, recognizing when the markets suggest that you change is fine. And it's so funny, Adam, even this year, when you have a YouTube channel where you have a daily market recap, you better have a thick skin for people being super critical. And just even this week, I had someone that went back and watched an episode I did like in mid-April and said, you were still bearish in mid-April. What's wrong? And I was like, I don't conditions weren't particularly great at that time. And looking back, it would have been great to buy on April 8th and not, but it's like I was still wondering what was going to happen. I kind of laid out a pen and then we went up. And so then eventually I said, all right, being bearish is no longer good. Not having the right call on every day is life. Sticking with the wrong call when the evidence tells you to do something different. That is the mistake that I try to avoid, that I would encourage people to try to avoid as well.
Well, I think risk management needs to come first.
Yeah.
I know on Market Misbehavior on your podcast, we talked about the analogy that we use at our office about how the signals that the market gives you that it might crash are like tornado sirens,
Yes.
and then the market
Yes.
crashing is a tornado.
Yeah.
And not every siren turns out a tornado, but you probably wanna go to the basement, at least that's how we roll at our house. But it also something else you said made me think of a conversation I had with our friend Andrew Thrasher. This was back in, like,
Yeah.
2022. He and I were talking for 45 minutes on the phone, just talking about the markets, and at the very end of the call, thought it was so funny because we were both just complaining, right? Stocks are down, bonds are down,
Yep.
only thing making money is commodity stocks for the most part, energy stocks. That's all
Yeah.
we really in our trend following models, that's pretty much all we owned,
Yep.
that and 75% cash. And he says to me, he goes, "The day I had it all figured out was the day that I learned that I was always gonna buy or sell too late, too early, too much, or too little." And once I had that figured out, I knew I had the whole thing figured out.
Just embrace that, right? Move on with your life. I think
Yeah.
that's true. I love it.
And to the investors listening and financial advisors, you have a phenomenal trading strategy when you're winning 60 to 70% of the time.
Oh, yeah.
When you're losing 30 to 40% of the time, you're a badass. That's
That's
the truth.
fantastic. Yeah.
Yeah. Okay. In your opinion, what separates the average investor from a great one when it comes to helping, whether it's navigating their own fear, emotion, and short term thinking, or for financial advisors managing their clients' fear?
Yes, 100% routines is how I would answer that. It's how you spend your time. For me, I built market misbehavior, and when I work with a lot of advisors today, it's just helping them think about, what do you do every day? What do you do every week? What do you do every month? What do you do every quarter to make sense of the markets, to evaluate performance, to make meaningful changes when needed. And I always tell people that a consistent but imperfect process is way better than an inconsistent perfect process, right? So don't strive for perfection, although eventually you always want to incrementally improve, but start with consistency, right? Think about what you do every morning. I call that the morning coffee routine. And I, over the years, have developed, for me to really understand the markets, this is how I need to spend about 30 minutes at the beginning of every day. And I'm going to do it every morning that the markets are open. And my weekly routine, I turned into a weekly report and video that I send out to all my clients, which is, here's what I learned last week. Here's what was new. Here's what was different. Here's what surprised me. Here's what made a ton of sense. Here's what I'm looking for in the week to come. Here are the levels, signals, patterns that I think we want to focus on. Here's what has the potential to really move markets. And here's how I think you navigate that. And for me, it's not having a perfect process, and it's not like I'm gonna be right all of the time, but that time spent the same way every morning, every week, every month has helped me dramatically improve the consistency of my returns and just have much less volatility and uncertainty and much more of a sort of well-rounded approach to appreciating the market conditions and how they change. Again, I'm going back to some of those behavioral biases. I think when behavioral biases start to create issues, it's because you don't have the right routines in place. It's because you have bad habits in place. And the problem with bull markets, which we're arguably right in the middle of, you can get away with all sorts of bad habits, right? You can be, everyone's a genius in a bull market, right? Things are going up. You have a great process. You're a rock star stock picker, whatever it is. But this is the time to really think about your routines and develop some good habits, because when the market turns lower, it's usually way too late to start thinking about how you want to improve those habits, right? So bull markets are a great opportunity to upgrade your routines, because bear markets are when they really start to matter.
It reminds me of our friend, it's you and then David Cox. Between you and David Cox, I honestly stole your pre-flight checklist concept. Because again, you're a pilot, and so
Yeah,
I thought that was a perfect name though, because every pilot needs to go through a pre-flight checklist to see what's
100%.
going on, what's the market look like, and that can be a
Yep.
pre-flight checklist for the day, the week,
Yes.
or the month.
Yes.
So I know David Cox, he does that too, and I stole that
Yeah.
idea from you, so it's something I do as well. Are there any, if you were to pick 2, 1 or 2, 3 at most, technical indicators or charts, because I'm leading you here because I know which ones you use, but the charts that you find yourself returning to over and over again, whether that's daily, weekly,
Yeah.
when you're doing your research that would help out investors and advisors, what would they be?
For sure. Yeah. So, most important tool that I use is relative strength, which I know you follow closely as well. And that's why we're kindred spirits. We're chart brothers for sure in how we approach the markets, Adam. And I think that because relative strength is so vital in helping you understand, the opportunity cost of whether you're looking at something, right? Because remember, when you're putting your capital into one stock, you are deciding not to put your capital in a bunch of other things. And so there are so many great analogies. You have a fantastic football analogy of investing in the playoff teams, right? And just focusing on the teams that you think have that potential to perform well and putting your chips there. I think of it like a baseball manager. And do you want to put your underperforming guys in a slump out on the field, or you want to put your top hitters at the top of their game, peak of their career? Like those are the players who are going to give you the best chance to perform well. So why do anything different with your portfolio? So relative strength is basically a set of tools to assess how a stock or ETF is performing relative to all the other things you could put in your portfolio or in your client's portfolio. I was trained if you're owning things and the relative strength is going down, you're just simply hurting you're underperforming, right? And the only way you outperform a passive benchmark is by owning things that are doing better than that benchmark, right? By definition.
Right.
Relative strength, by far the most important thing I would look at. On top of that, I look at momentum. So I use RSI as a measure of price momentum. For me, that has become incredibly valuable thinking about multiple timeframes, thinking about the tactical time frame, which is just the short-term peaks and valleys, the swings in price, and how those swings basically transform into larger trends over longer periods of time. And so thinking about where we're at, thinking tactically whether today is the right time to be adding to a position or not, has helped me to incrementally improve returns over time. That's what we would do with a lot of the Fidelity portfolio managers, is just help them optimize entry and exit points a little better. They would have really good ideas, but just ignore what the markets were doing. So they would be buying at peaks and they'd be selling at valleys. And just by improving that, we're able to meaningfully improve returns over time. And then for me, the most important part, probably more than anything, is just tools for risk management and tools for me to systematically screen through things I'm holding or a watch list and see what's not working anymore. And I use moving averages for that. I use a series of tools to just say, when this happens, when XYZ happens, that tells me this trend that I've been following is no longer working. And just having a consistent process of looking for those reversals has really helped me to not ride things down as much as I probably would have done otherwise.
No, that's awesome. Yeah, that's there's obviously a whole lot more to unpack there. So I'm just gonna say right now that I occasionally get asked, "Hey, if there's is there one book I should buy or something I should get to learn how to be a better investor?" I would
Yeah.
just encourage people to go to Market Misbehavior and check you out and sign up for your
Yeah.
blog, honestly, because I think they're gonna sift through a lot of BS that gets in people's way. Honestly, it's gonna help. It's gonna be so much better than so much else that's out there. But for the next generation of financial advisors, we'll say this time, especially for those trying to build a scalable firm, is there one I know you're big on mindset, you're big on
Yeah.
psychology. Is there one mindset, skill, or habit that you'd encourage them to develop right now to become better at what they're doing?
Ooh, that's such a great question. There's so many, right? And we've talked a lot about routines, so I won't beat that one anymore. What else would I say in terms of mindset? To me, I have so enjoyed thinking of the markets as a learning opportunity. And I remember the first CMT, it was an MTA meeting at the time. The CMT Association is a technical analysis professional organization. I remember the first meeting I went to in New York. This was like early 2000s. And I'm sitting there listening to someone speak. And then afterwards, they had a queue and a couple people, a couple seats down, this guy who was probably in his 70s raised his hand and was asking questions. And I was like 21 or 22. And I remember looking down, I'm like, if this is something where, like, at that stage in your life, you're asking questions and learning and just thinking about what's new and different, I'm like, that sounds fantastic. What a cool opportunity. What a cool game to play. What a cool role to be in. And so I would encourage people to approach the market. I always try to describe myself as a student of the markets. So thinking about how you can invest not just in your portfolio, but invest in your education. Think about how you can upgrade every year and just try to improve how you're approaching the markets. I think having humility that comes with being a student is a big thing as well. I would say there's a lot of bravado, a lot of I got this, a lot of overconfidence that happens in all sorts of financial roles. And for me, the most successful investors aren't necessarily the smartest ones. They're the most aware, right? They're the ones that know what they're good at and they're very clear. They're humble enough to recognize what they're not good at. And for me, the most successful investors, and I've been able to work with Steve Cohen type of successful hedge fund investors all the way down to people trading a couple $1,000s in their Robinhood account and everyone in between. And I think the most successful investors across that spectrum are the ones that are really clear on what they're good at and really clear on what they're not good at. And surrounding yourselves with resources and tools and techniques to address your weaknesses, that's, I think, the most important part of the game.
Yeah. Stay modest, open-minded,
Mm,
or don't be closed-minded. Be
yeah,
aware, stay
yeah.
thirsty for knowledge, and never stop asking questions is what I just heard you say.
Yeah, so that was like 3 or 4 things, but sorry, but yeah, that's what I was
Well, I
saying.
like it.
That's fair.
No, I'm just recapping because I think that's all
Yeah.
going back to that call I was on the other day, it's like most people were shooting daggers, right? Instead of being open-minded and wondering, "Oh, I wonder how that would look with a back test." They're thinking, "Oh, it doesn't work. It doesn't work." It's like, "No, it works.
It's
It
so
it
and
works."
what's I tell you what, so in terms of asking questions, if I can share one anecdote, I think one of my another memorable experience, a number of meetings at Fidelity where top portfolio managers, these are guys that had been outperforming benchmarks for 20, 30 years, just had shown that they could invest successfully and grow assets and perform well. And then we would go into meetings with companies and they would ask really thoughtful questions. I assumed they would just have all the answers. They were so knowledgeable, they just knew everything. They didn't. They were actually very open about how much they didn't know. They read a ton. I would go into a portfolio manager's office, they would have a stack of books that they were getting through. It's like, nanotech is going to be the next big thing. I'm reading this book by this guy who's a nanotechnology expert. And then blockchains, like early days in Bitcoin, I was like, this is going to be a thing.
Yeah.
And the Bitcoin ATM showed up in South Station. All of a sudden, everyone had books about blockchain and just understanding it. And you would sit down with company management and not show how much you knew. You would show how much you didn't know about their business and just ask questions about, help me understand this. Why are you thinking this is going to be so meaningful? And so the best investors weren't the ones that had all the answers. They're the ones that asked the best questions. So it's something I try to keep in mind for sure.
I love that. No matter how old you are too, no matter how experienced.
Yeah.
All right, that's our time today. I've already plugged market misbehavior to death, I think, but I'm gonna say it again. Dave also has a daily chart, like a market update after the close every
Yeah.
day.
Yep.
It's Chart This with David Keller. It's on YouTube. Check that out. You can find him on Instagram, Facebook, LinkedIn, of course. Is there anything else you want to plug? Anything else I'm missing?
No, you're so kind, Adam. I appreciate it. No, thanks so much.
Yeah. All right. There's thousands and thousands of podcasts out there these days, and you chose to give ours a listen today. So thank you so much for tuning in. We'll see you next time.
Thank you for tuning in to the Advisors Fuel podcast. For more articles, videos, and resources, or to schedule an intro call, visit adrenalineadvisor.com. This podcast is for informational purposes only and should not be relied upon as a basis for financial or legal advice. Always talk to your compliance department before implementing any of the ideas shared in this episode.